Welcome to The Explainer. Today, we're diving deep into something that's on pretty much everyone's mind: AI and your money. We're going to go way beyond the headlines and the hype to really understand the machinery, the actual cash flow, and the kind of thinking you'll need to make sense of what's coming next.
This question, which is inspired by the legendary Charlie Munger, is all about what he called second-level thinking. See, it's easy to look at AI and just say, wow, it's huge. That's first-level thinking. But the real insight, the place where you find the actual advantage, is when you ask, okay, so, and then what? What happens because it's huge? What are the ripple effects? That question is really going to be our guide today. So here's our game plan. We'll kick things off with the AI gold rush, then we'll get down to earth and look at the real-world stuff that makes it all run. From there, we'll poke at the bubble, talk about some risks you might not see coming, and then lay out a solid playbook for investors. And finally, we'll take a peek over the horizon to 2026. All right, let's jump right in. We are smack dab in the middle of a modern-day gold rush. I mean, money is just pouring into anything with an AI sticker on it. The speed is it's staggering. And that's creating this massive wave of excitement. But also, as you're about to see, some pretty wild and maybe even scary valuations. Just look at this number, 2.52 trillion with a T. That is the projected worldwide spending on AI by 2026. To try and put that into perspective, we're talking about a 44% jump year after year. That isn't just regular growth, folks. That is an absolute explosion. And that is the rocket fuel for this entire market.
And check this out. What's absolutely crazy here isn't just the size of the numbers, it's the sheer speed. Now, we're not even talking about how much these companies are worth. This is their annualized revenue, basically the pace of money they're on track to bring in over a year by late 2025. OpenAI at a $13 billion run rate, Anthropic at $7 billion. I mean, that kind of explosive growth, that fast, that's exactly what gets everyone thinking gold rush.
So you might think all the big tech giants are all playing the same game, right? Well, not really. Their strategies are actually starting to split apart. On one side, you've got companies like Meta and Google who are just swinging for the fences, spending billions to build the next world-changing AI model. It's a huge risk. But then you have Microsoft and Amazon, who are kind of playing the role of the landlord. They're building the infrastructure, the apartments, if you will, and then renting out space to everyone else. This split is super important to understand because it tells us that even the giants aren't a sure thing here. And what happens when all that excitement and all that money hits the stock market? Well, you get some valuations that are, let's just say, out of this world. Palantir trading at 110 times its sales is just breathtaking. It really takes you back to the dot-com bubble. I mean, back then, everyone thought Cisco was a can't-miss stock because they were building the backbone of the internet. Kind of like how people talk about NVIDIA today. But the lesson from that era is a tough one. Even the most important company in the world can be a terrible investment if you pay way too much for it. So we've talked about all this money flying around, but where does it actually go? It's easy to think AI is just code floating around in the cloud, but the truth is, this revolution is being built on a foundation of real, physical stuff. It really is a business of atoms, not just bits.
Okay, this phrase right here, industrialization of inference, is super important to get. Think of it like this. For a long time, all the money and effort went into training the AI. That's like sending it to college for 4 years. It's incredibly expensive. But now, the big shift is to inference. That's the AI graduating and actually getting a job, doing real work out in the world. We're moving from the schooling phase to the doing phase, turning AI from a cool science project into an industrial powerhouse.
And this physical setup isn't simple at all. You can't just have one giant computer do everything. It's really more like a 3-layer cake. At the top, you've got the huge, insanely powerful cloud data centers. That's where you do the heavy-duty training. In the middle, you have on-premise servers. Think of them as the steady workhorses that handle the day-to-day grind of inference efficiently. And then, at the very edge, you have tiny, super-fast processors in things like your phone or in a car, making split-second decisions where there's just no time to call home to the cloud.
It's so easy to think this is all about NVIDIA's latest chip, but that's just the tip of the iceberg. To make AI work at scale, you need this whole ecosystem of incredibly specialized hardware. We're talking custom-built chips, plumbing systems that pump liquid right onto the processors to keep them from literally melting down. And here's the kicker. The bottlenecks, the things that slow everything down, are changing. It's not just about getting more GPUs anymore. Now it's about these weirdly named packaging technologies, it's about specialized memory, and honestly, it's about just finding enough raw power and water to run the darn things.
Okay, so this is where the plot thickens. We have this massive build-out, trillions of dollars being spent, and now we have to ask the really uncomfortable question. Where are the profits? Because right now there's a huge and frankly kind of scary gap between the money going in and the money coming out.
Let's put some hard numbers on that gap. The big cloud companies are dropping over $400 billion a year on AI stuff, but they're only seeing about $100 billion in new AI revenue from their customers. So for every $4 they spend, they're only getting $1 back in new business. That's a big problem. And it's not just me saying it. A massive firm like Vanguard is saying there's a 1 in 4, maybe even a 1 in 3 chance that AI just doesn't produce the profits everyone is betting on.
So you gotta ask, right? How is this working? How can you spend $4 to get $1 back and still look good? Well, part of the answer is some, let's call it, creative financial engineering. It's this thing called a circular financing loop. Here's how it works. Big tech company A invests $1 billion in an AI startup. Then the startup immediately turns around and uses, say, $800 million of that money to buy cloud services from, company A. So company A's revenue just jumped by $800 million. But it was their own money. It's like paying yourself and calling it a sale. It makes it really, really hard to tell what the real demand actually is.
And we've seen this movie before. Maybe not this exact plot, but we've definitely seen the genre. You get a revolutionary new technology, a ton of money pours in, and then pop. The dot-com bubble in 2000, the flash crash in 2010. These things happen when hype gets way, way ahead of reality. And it makes you wonder, is 2026 going to be the year that AI hits its own trough of disillusionment? The moment the party stops and the hangover begins.
So the valuation risk is pretty obvious, but there are other dangers lurking in the shadows. These are the kinds of risk that you won't find on a spreadsheet. We're talking about the brutal speed of technology, making today's miracle obsolete tomorrow, and a whole new world of security nightmares that companies are just now waking up to.
Think about this for a second. What's the one thing that can destroy even the most amazing new technology? Time. And that leads to the billion-dollar question that investors like Warren Buffett spend their entire lives trying to answer. What makes a business last? In a world that's changing this fast, what's actually a safe bet?
Okay, let's make this super simple. Charmin toilet paper. Kind of boring, right? But guess what? People are still gonna need it in 20 years. Its business is pretty safe. Now, remember Sirius satellite radio? It was a technological miracle, radio from space in your car. But then came podcasts, then came Spotify. Boom, practically obsolete. That's the terrifying thing about tech. It gives and it takes away. It's a process economists have a great name for, creative destruction.
And then there are the brand new security headaches that are giving executives actual nightmares. You've got shadow AI. That's when your employees start using random AI tools on their own, leaking company secrets without even knowing it. Then there's data poisoning, a wild new type of hack where you can literally trick an AI by feeding it garbage data. And to top it all off, you have this legal mess where different states and the federal government are fighting over who gets to make the rules for AI, leaving businesses totally in the dark. Okay, so we've waded through the hype, the hardware, and the hidden hazards. So what do you do? As an investor, how do you actually play this game without getting totally burned? How do you find the real opportunities amongst all of this noise? Look, there's no magic bullet here, but there is a time-tested playbook that works for pretty much anything. It's built on 4 pillars. 1, fundamentals. Is the business actually good? Does it make real money? 2, technicals. Is the stock price trending in your favor? Don't try to fight the market. 3, cash flow. Can you get paid while you wait through dividends or other income? And 4, and this is maybe the most important one, risk. Plan for things to go wrong. Always know your exit strategy before you even get in.
So what might that look like in practice for an AI-focused world? Well, here's one way to think about it. You build a strong foundation, maybe 40% of your portfolio, in just plain old broad market funds, safe and steady. Then you bet on the tool makers, the picks and shovels companies, with another 30%. They tend to win no matter who strikes gold. With 20%, you get more specific, trying to find the ag companies that are actually winning in a specific field, like healthcare. And then, and only then, do you take a small sliver, maybe 10%, for the crazy moonshots, the ones that could go 100x or could go to 0.
All right, let's wrap this up by looking at what's coming down the pike. The first chaotic phase of this gold rush is starting to settle down.
As we look toward 2026, the game is changing, and a few really big trends are taking shape. The whole conversation is shifting. First, you're going to hear the term agentic AI a lot more. This isn't just a chatbot answering a question. This is an AI agent that can go out and perform a whole series of complex tasks for you, all on its own. Next is physical AI. This is where the digital brain of AI gets a physical body. Think super smart robotics on the factory floor. And finally, sovereign AI. This one is huge. Countries are now treating their AI capability as a national treasure, like having an army or a currency, and they are racing to control their own. So there you have it. We've gone from the crazy hype to the nuts and bolts to the hidden dangers. You can feel the market shifting under our feet. The build it and they will come phase is ending. Now it's all about who can actually make money and solve real problems. All the big pieces are on the board, but the game is really just beginning. Which brings us right back to where we started. You've seen the boom, you see what's happening. So the question is, what are you going to do about it? What's your second-level move?